Good morning. Happy Thursday. A few minutes late, but that's kind of the new norm, right? Like if I'm on time, people are shocked and not ready to go. So happy Thursday, everybody. Everyone's having a great week. I missed last week's Q&A. I was down and I was in bed for 2 days straight. So sorry about that. I appreciate you guys' patience. And that said, if you guys are here today and you want to ask some questions at the end, I have not shortened, but I've kept this to like 20-ish minutes. So if there's questions that you guys want answered at the end of this session today to make up for last week's missed live Q&A, happy to do that. I'll make that announcement again at the end as well. So yeah, today we are talking about what counts as a business expense, right? We're going to debunk common myths about what counts as a deductible expense, maybe get over some fears of some things that are allowed that maybe sometimes we're scared to take as business owners. And we'll clarify the rules and provide examples of some legitimate deductions that will help you guys stay compliant as business owners. All right, and then next week, it's not really a part 1 and part 2, but next week, next week's is common tax deductions for a small business. So what we're gonna go over next week is jumping into some specific business deductions that you guys are allowed to take and kind of talk about. It's called common tax deductions, but I'm actually gonna, we'll talk about some of the common ones, but I also want to talk about some of the more, not necessarily uncommon ones, but the ones that, like I said, that people sometimes are afraid to take or unsure where that line is. So that is what we'll talk about next week. But today we're really talking about what counts, right? What makes an expense a business deduction. If you are new here, hi, I am Bree Beers. I own Bree Beers and Associates in Denver, Colorado. I am a CPA, certified tax coach, advanced tax strategist, fractional CFO. I've been in accounting for over 20 years. And this 15th tax season, whoa, that flinched. That was weird. I don't even know. I've been doing taxes since 2011, maybe not. I don't know. But I've owned my business for about 7 years, and that intersectionality of being an accountant, being a tax accountant, and being a business owner, I think being an entrepreneur gives me an additional way to help you guys as fellow business owners in learning how to take advantage of the tax code. That said, I've probably spent the last 6 or 7 years at that point really learning the tax code above and beyond just tax prep, right? Really learning the tax planning and tax strategy, and then figuring out how to take what I've learned in what's available to us as small business owners in the loopholes, and figuring out how do I take what I'm learning and take those tax strategies that are available to us. How do I help the small business owners, right? Because typically we think of tax planning as reserved for the rich, the wealthy. And the reason we receive that perception is because the rich and the wealthy are the ones that have resources and teams to take advantage of all of these loopholes that exist. But truly, so many of them, guys, are built for small business owners just like you and me. So that's my goal here, is to help you guys figure out how to utilize those strategies in your own small business. So that's me. So today we're talking about what counts as a business expense. All right. And we hear this a lot, right? Is this a write-off? Can I write this off? But what really is a write-off? And if you know me, you're not going to be surprised that I'm going to share a clip from Schitt's Creek with you guys to open up this training. I've never done this, so hopefully my screen cooperates. Okay. And hopefully my sound works. So let's do this. All right. Fun way to start the morning, right? All right. How do we get that off? Back to me. Okay. Fun. I love that show. And yeah, I love his definition, right? He's like, he gives a great definition. All right. And so let me get back to this training now that I just want to watch Schitt's Creek. Thursday mornings. All right. So, what counts as a business expense, you guys? So, today we're talking about this because we want to learn the purpose of us being here today is to really learn how to determine if a expense qualifies as a legitimate business expense, right? Because we have people on both sides of the fence, right? We have the people out there, we see them on TikTok, we see them on Instagram, we see them on social media who are telling you that everything is a write-off. Run everything through your business and make it a write-off. Not quite. And then we have people on the other side of the fence who are, they're scared of an audit. They don't want to deal with the IRS. And so they are like, I don't even want to say by the book. They're even more beyond the book. If anything sounds sketch or unsure, they're like, I don't want to take it. I'm not going to run through that through the business. And there is a happy medium, you guys. So understanding what is a business deduction and what is not is important because it's going to save you money on the one side. It's going to save you stress on, both sides and potential IRS trouble on that first side. All right. So like I said, we've seen taxpayers on both sides. And so what we start with is the actual IRS definition. All right. Because there are two key factors that the IRS tells us are required in order for a business expense to be a tax write-off or a tax deduction. And that is that it needs to be ordinary and necessary. All right. And so in the easiest terms, think about it like this. All right. If a graphic designer is buying an iPad, totally ordinary and necessary, right? If a hairstylist is buying a new oven for her house, that doesn't make sense, right? And so this ordinary and necessary, even like to this day, I'm in accounting groups and I'm in different forums, and there are accountants across the spectrum in terms of what ordinary and necessary actually truly means. All right. So when we think about it in its simplest terms, ordinary is common in your industry, right? Is this expense that you are paying for common in other businesses within your industry? And is it necessary? Does it help your business operate? And does it help your business grow? All right. Seems pretty simple, right? Okay. Is it common and does it help my business? Right. But it's not always that black and white. And that's why even amongst accountants, you get into arguments about ordinary and necessary. And we'll talk about some real life examples in just a moment. But it's not always black and white, right? Because some expenses are going to be clearly business related, while others, fall into a gray area because usually it's that necessary piece. All right, ordinary and necessary. So but when it comes down to it, you guys, reasonableness matters. All right. And when I say that is the amount of money you're spending on certain expenses in relation to how much money you're bringing in, it matters. All right. The IRS expects you to spend money in a way that makes sense for your business type and your business size. All right. So something that might be ordinary and necessary for a 10-figure company is not going to be ordinary and necessary for those of us starting out that are just maybe hitting that 5-figure mark. All right. And on that same token, industry norms are going to play a role. Okay. So what's deductible in a construction company isn't going to be the same for a service consultant. All right. So like an example I gave you, for a hairstylist buying a new oven for their house, not business related. A baker who uses their own, who uses their personal kitchen to bake cakes or cookies, maybe an argument for that. All right. There's some nuance about personal to business, proportion of use. But the point is, what industry you're in and what you're spending your money on matters. All right. So a couple more examples. A photographer buying an expensive camera lens makes sense, right? I'm a photographer. I'm starting to make money. I want to take better pictures. So I'm going to buy a new lens for my camera. Cool. Makes sense. Even if this camera lens is thousands of dollars, and I'm only making thousands of dollars, if I can justify that as soon as I have this camera lens, I'm going to be able to double my prices or I'm going to get more business, right? Even though it seems financially on the high end for how big I am, it's going to help me make more money. And so, yes, the IRS is going to allow me to take that as a business expense. However, the travel is one that gets a little sketchy. And if that photographer is trying to write off an all-inclusive vacation because they took photos while they were gone, that's not reasonable. All right. That's not to say if you're a photographer and you're traveling to take pictures that your travel time and effort is not deductible. It is. But same thing, if you are making, if you're just starting out and you're making a couple $1,000s as a photographer and a year. So let's say we're making $10,000, right? We're just starting out. It's our side hustle. We're getting a few, jobs a year. We're just starting out. And then we take an all exclusive, we're going to go do a wedding, right? We're going to go do a wedding. We're going to be doing, filming for 2 days down there. We're going to be like, okay, yeah, that part's deductible. If we decide to make this a whole vacation, we stay down there for a week and a half, and we are at an all-inclusive resort and we're spending tens of thousands of dollars more on this vacation than we even make in a year, that's going to raise some red flags. All right. It's going to cause some problems with the IRS. All right. So ordinary and necessary, they work together, right? Ordinary in your industry, necessary to keep your business running. All right. It's likely deductible. Okay. If it's personal, if it's excessive, if it's not directly related to making you money, it's going to be hard to argue that in front of the IRS. All right. And I want to make a few more examples, all right, of things on both sides of the fence, because with our clientele, we tend to get more clients on the conservative side than the, deduct everything side. And there was a court case, I don't know, I'm going to say a few years ago, it's probably at this point 10 years ago, but there was a real estate agent, 10 million, like she was making over 10 million a year, okay, down in Florida, right? So she was a very high-end realtor, all right? And she bought a boat because her real estate clients wanted to see the properties they were waterfront properties. They wanted to see the properties from the water side, from that approach. The IRS flagged her, said, real estate agent, boat, what, really? She went in front of the IRS, or she didn't, her attorney did. Her attorney went in front of the IRS, argued the reasoning for this being ordinary and necessary, showing that, she spent, I think it was like a $300,000 boat, right? She spent the $300,000 on this boat. She brings in over $10 million a year. So ordinary, like the reasonableness was there. Okay. It's not a huge amount compared to what you make. Right. And then when she talks about the reasoning, she's in this, she only uses it for business. She only takes clients, out, blah, blah, blah. She was able to win that IRS court case or audit. I can't remember which one it was. It might've been a ruling. But yeah, but however, if I was to go out and buy a $300,000 boat right now under my business, the IRS would laugh at me for numerous reasons. One, I don't make $10 million. So the reasonableness is not there. Two, what does an accountant need with a boat for business purposes? Right. And I mean, that's it. It's the reasonableness and the ordinary necessary, right? So that's an example. But let's talk about where people tend to get in trouble. Again, next week, I want to remind you guys that next week we are talking about common tax deductions for small businesses. And we're going to talk about what we're going to talk about next week is really talking about how to move money you're already spending into your business, right? And run it through the business in a legal, ethical, and proper way. But let's just talk right now about some of the basic expenses that qualify, right? Expenses that qualify as business expenses that you may or may not be taking. All right. And I'm going to ask, because especially for my startups, and I know we get people on here across the board, right? We have some that are just starting out on their side hustle, barely making $1, just trying to figure out what to do. We have some people who are starting a business, right? They've quit their job, they're full in on this business, but they're still not to the point where they're making money. And then we have some, established, companies that business owners who've been in business for, 3 years, 5 years, 10 years. We have some veterans in here, right? And so the veterans, this is not going to be news to you, right? You're going to listen to this list, you're going to be like, yeah. But for my other 4 buckets, listen up, because these things are going to kind of, you might get a nugget in here of like, oh, that's interesting. I did not know that was deductible. All right. So again, for my veterans, a lot of these are going to be like, yeah, I do, that's obvious, but so this is more for my non-veterans, okay? So we'll start with office and supplies. All right. Your laptop, printer, ink, software, paper, pens, all the stuff that especially if you're a consultant, right? Like, and you're doing like, hello, I'm an accountant, I'm in an office, everything about my computer, my printer, all the stuff in my office, I use only for my business. It's all a business expense. All right. All the ink that goes through my printer, all the pens, all the paper, everything in here. All right. I know lots of people sometimes are like, well, I have a personal computer that I also use for business. Partially business deductible. We can help, your accountant can help you with that. All right. But anything in your office and your office supplies, yes, deductible, right? Marketing and advertising. So it comes back to if it's helping you, earn money or grow your business, it's a business expense. So website hosting, social media ads, business cards. This, guys, is an area where if you sponsor a youth team, right? If your name gets on the back of a jersey, that's a marketing and advertising. Some people think it's charitable contributions. It's not. First of all, for numerous reasons. One, even if you're doing it out of the goodness of your heart, right? You're like, hey, I'm going to put my name on the back of these shirts. I hope I get a new client out of it, but I also just want to support this team, or this youth team or this organization. It's a marketing and advertising expense. All right. Travels and meals. We've done a whole training on travels. We've done a whole training on meals. So I'm not going to dig into it totally, but there are ways for you to make travel and meals deductible, right? So I got a client in last week or the week before whose previous accountant told her that even traveling she wasn't an accountant. She was in consulting of some sort. I can't remember. We're going to go with IT consulting. I don't think that's what it was, but that's what we're going to go with. Okay. She was an IT consultant. She and her last accountant told her that she was not allowed to deduct the travel to go to an IT conference. That is false. That's not even, guys. And we talk about like there being a spectrum of accountants and their allowability of what's allowed and what's not. All right. And then there's some people who are just straight out the box, right? On both ends. There are some people that will tell you can deduct all these things that absolutely you can't. And there's going to be people out there that tell you not to deduct that because it's too risky. But most everything is in this gray area. And it's not gray area. It's deductible as long as it's ordinary and necessary and you document it. All right. So yes, if I am going to Vegas for an accounting conference for 3 days, all right, and I only go for the conference. I fly in the day before the conference. I'm there for 3 days. I fly out the next day. My whole travel, my whole lodging, and my food for the time I'm there are going to be considered business deductions. All right. Now, entertainment is not. So if I decide to go to a show, if I decide to gamble, if I decide to, go on the New York roller coaster or the Stratosphere, that stuff not deductible. Entertainment is not deductible right now under the 2017 Tax Cuts and Jobs Act. But 50% of all my meals are, my flight is, my hotel stay is, all right? So travel and meals is an area, again, that it's an area of opportunity for most business owners to take more advantage of. All right. Education and training, same thing. If you're taking a course or you're trying to get certified in something related to your business field, those expenses are deductible. Right? Any contractors or employees, this seems like a no-brainer, but paying anyone to help you, a virtual assistant, a bookkeeper, hiring staff, that's all a business deduction. And then we get into the home office and the vehicle expense. This can get a little tricky in terms of making sure you do it properly. All right, making sure you calculate it right, but that's what a good accountant is going to help you do. So home office, right? This is my designated home office. I think it's a 12 by 12, which is what, 144 square feet. All right. Let's just say my house is, so let's say my office is 140 square feet and my whole house is 1,400 square feet. Then 10% of all my expenses related to my entire house are going to be a business deduction under the home office. Home office is one that there are accountants and taxpayers who are hesitant to take home office for different reasons, but it is absolutely one that is available to you. Okay. And then there's vehicle expense. That's the same thing. If you use your personal vehicle for your business in any way, shape, or form, there's going to be a deduction available to you to some sort, right? Or if you have vehicles that you use solely for your business, right? If you have construction companies that have trucks, if you have plumbing companies who have vans that are, used to go to different jobs, those vehicles are going to be 100% business expenses. All right. Your personal vehicle, you can take a portion of things of usage, right? You can either deduct mileage or you can deduct a percentage of actual expenses. But yeah, all things that you're allowed to deduct. All right. So just a few things that don't count, right? Just want to go through a few. These do not count items. Okay. Political donations and lobbying. All right. You're allowed to donate. You just can't deduct it. All right, fines and penalties. So speeding tickets, IRS penalties, those are non-deductible. All right. Over the top purchases, right? We talked about being excessive. All right. So if you, so really keeping into that reasonableness piece, because even if there are things that yes, based on my industry, this makes sense. And yes, I need it to grow my business. It has to stay reasonable. I think there's a saying, is it pigs get fat, hogs get slaughtered? All right. So make sure you're staying reasonable in terms of your industry, but most important, the size, how much revenue you're bringing in versus how much you're spending on these expenses. All right. And this is where travel, meals, and entertainment can get you into trouble if you're getting greedy or sloppy or, whatever. And then personal everyday disguised as business. All right. Everyday clothes, groceries, family vacations, not deductible. There's a few loopholes, but the thing that we get, guys, is personal grooming, nails, hair. We get real estate agents and even hairstylists who, they say I should get to deduct my hair and my nails because I have to look good for what I do. I don't disagree with that, but the IRS does. The IRS specifically says those things are not deductible. With a few exceptions. Some exceptions being if you're in entertainment, right? So if you're a model or an actress or a performer, then you can get away with some of that. When it comes to clothes, a workaround for you guys is to logo things. Okay, so if you want to go buy some polos, right, and you put your business logo on them, the shirt and the logo cost becomes a business expense. Okay. Uniforms, those kind of things are good, but unfortunately, I have to buy nice clothes because I have to, I'm a realtor. Again, I get a lot of realtors who really want to take these expenses, and it sucks because I can't let you. It's not a gray area. It's a very clear no from the IRS on those. All right, and then just before we leave, we want to talk about just how to properly track the expenses. All right, so the first thing all of you should be doing if you have a business is have a separate business bank account. Your business and your personal money should not intermingle, period. All right, for so many reasons. One, if you have a legal entity set up, a corporation, an LLC, a partnership, then there's a thing called a corporate veil. Hashtag I'm not a lawyer, but I know that as soon as you start commingling and intermingling your personal and your business funds, you pierce that corporate veil. So that's a no-no. Which again, from a legal side, I'm not an attorney, but the reason you set up a separate legal entity, right, is so that if that legal entity, if your business gets sued, they can't come after your personal assets, right? So Bree Beers and Associates gets sued for something. they can't come after my home, my car, anything that's not within the business because that corporate veil exists. As soon as I start intermingling funds, then we have a problem. All right. But also from a financial point of view, we want separate business and personal bank accounts to help you track your finances, to help you track your expenses and track your income. So many people think that they can just go back through their statements and identify which transactions were personal versus business, and you can't do it. You're going to leave money on the table. All right. So just open a separate business bank account and run everything with your business related to your business through that separate business bank account. All right. Use a simple system to track. All right. We're always going to recommend you get on QuickBooks Online or Xero or some sort of platform that we can pull a P&L and a balance sheet from, right? But if you're not quite there yet, even a simple spreadsheet, okay, can help you guys to, because you want to be able to, for tax purposes, right, be able to say, here's all my income for the year, here's all my expenses categorized into, IRS approved categories. All right. But also, you want to be able to, from a financial point of view, you want to be able to make data-driven decisions. And in order to do that, you have to have your financials. You have to be able to know where you're sitting. All right. How much money is coming in, how much money is going out. All right. And the last thing is keep receipts for at least 3 years. If you use QuickBooks Online or Xero or pretty much any software, you're going to be able to take a picture with your phone and connect it to the software directly so that you have those receipts. I will tell you, I have seen I have seen audits and I haven't been through audits, but I've witnessed or been part of audits where bank statements and credit card statements sufficed when everything ran through a bank or a credit card. But the IRS, while it worked, the IRS says that's not enough. All right. So the IRS says keep all your receipts, even if you run everything through a checking or bank account. But if you forget a receipt or you don't save every single receipt, there's a good chance you'll still be okay should you get audited. All right. But it's also more just so you can remember what it is you bought, right? Because even if you have your bank statements, it just tells you where you spent the money and how much you spent, right? Where and when you spent it, where you spent it, how you spent it, right? It doesn't give you the detail of what you bought. The receipt does that. And also, we do not recommend that you keep folders full of receipts because A, that's clutter, and B, they fade, right? We all know that carbon paper, it just fades after not even months, right? So terrible idea. So take pictures, put it in whether you, like I said, connect it to your QuickBooks Online account, or even just keep a file set called business receipts. You're not going to have to go into it, guys. It's there just in case the IRS comes knocking, which 0.01% of returns get audited. Okay. And you guys, the IRS loves digital records. Okay. If you do ever get audited, having a well-organized set of expenses and receipts is going to make your life easier. And the more organized you are, if you do happen to get audited, the more cooperative your auditor is likely going to be. All right. Cool. I went over time, but I also started late, so we're good. But I do have another call to get to. So thank you, as always, for joining us, you guys. Just to remember, ordinary and necessary. All right. If it's ordinary and it's necessary, it probably counts. Keep it reasonable. Okay. Keep it reasonable and keep your records and keep your personal separate from your business. All right. And the more you track, the more you save. Right. Remember, when you keep that business separate and you're able to see every dollar spent, then you're able to save more. All right. Next week, it's called common tax deductions for small businesses, but really I'm going to go over the things that the tax deductions where I see the most money able to be saved. All right. So I will see you guys next week and have a good weekend. Bye.